All right, so if you're a serious silver investor, you've definitely seen these two tickers floating around, PSLV and SLV. Now, on the surface, they look pretty similar, right? They both track the price of silver, but what's going on under the hood? Well, that's a completely different story. The legal and structural differences are huge, and they really get to the heart of what you actually own. So let's dive into this, because this is about so much more than a ticker symbol. It's about the fundamental security of your investment. And that brings us to the big question, the one that probably keeps some precious metals investors up at night. When you click Buy on one of these funds, are you actually buying a title to a real physical silver bar sitting safely in a vault somewhere? Or are you just buying a financial product, a piece of paper silver that promises you metal, but might not be able to deliver if things get crazy? That is the critical distinction we are going to unpack right now.
Okay, here's how we're going to break it all down. First, we'll tackle that whole paper-silver problem. Then we'll dig into what allocated versus unallocated really means. And trust me, this is key. After that, we'll see if you can actually get your hands on the physical metal. We'll compare the different fund structures, look at a really surprising tax difference for US investors, and then wrap it all up by figuring out which one of these tools is right for you and your goals. So what is this paper-silver problem everyone talks about? Well, at its core, it's the fear that the number of financial claims on silver, like shares in an ETF, might be way, way bigger than the number of actual physical silver bars available to back them up. It's the risk that in a real financial crisis, it's like a game of musical chairs. The music stops and there just aren't enough silver bars to go around for everyone holding a paper claim. This slide really just cuts right to the chase. This is the single biggest difference between the two. On one side, you have PSLV, which is designed to be like a fortress. It holds only fully allocated physical silver, one-to-one backing. On the other side, you have SLV, which operates more like a bank. It holds some allocated silver, but its prospectus also allows for unallocated claims, which are basically IOUs from a bank. And that brings us to the two most important words in this entire debate: allocated and unallocated. Honestly, understanding these two terms is at the very heart of knowing what you truly own. With PSLV, when they say allocated, they mean something very specific. Your shares correspond to actual identifiable silver bars. We're talking bars with serial numbers, specific weights. You can literally go online and see a full list of them. And this silver is stored at the Royal Canadian Mint, but, and this is huge, it's legally separate. So even if the mint itself had a problem, your silver is walled off and protected. It's your property, plain and simple. Now let's flip the coin. Let's look at an unallocated account, which SLV is allowed to use. In this setup, you don't own any specific bars at all. What you own is a claim against the custodian bank, in this case JP Morgan, for an amount of silver. You've basically just become a lender to the bank, and the silver is an asset on their balance sheet, not yours. So why does that matter so much? Well, here's the crucial point. If you are a lender to a bank, and that bank fails, you become what's called an unsecured creditor. And that means you have to get in a long line with everyone else the bank owes money to, hoping to get some of your investment back. You might get pennies on the dollar. You might get nothing. That is counterparty risk, and that is the exact risk that PSLV's structure is designed to completely eliminate. Okay, so what's the ultimate proof that the physical metal is really there? The real acid test is whether you can trade your paper shares for cold, hard metal. So let's look at the redemption rules for both. Can you actually get your silver? For PSLV, the answer is a clear yes. Now let's be real, the minimum amount you need to redeem is very high. We're talking enough shares to equal 10 huge 1,000-ounce bars. So it's not something most people are going to do. But here's the critical part. The fact that the option exists for any investor forces the trust to act with discipline. They have to have the physical metal on hand at all times, just in case.
And what about SLV? For a regular investor like you or me, the answer is a simple, flat no. You cannot redeem your shares for physical silver. Period. Only a handful of massive financial institutions, the ones they call authorized participants, are allowed to do that. This really reinforces the idea that SLV was built as a price tracking tool for big banks, not as a physical ownership vehicle for individuals.
This massive difference in redemption rights is directly tied to the basic DNA of these funds. One's a closed-end trust, the other is an open-end ETF. And how they create new shares? Well, that's a real game changer. Okay, think of it like this. With PSLV, the metal always comes first. They have to physically buy the silver and put it in the vault before they can issue new shares to sell. It's a very disciplined process. SLV, on the other hand, can create new shares pretty much on demand to meet buying pressure in the market, potentially using those unallocated bank IOs as a temporary placeholder until they get around to sourcing the actual metal.
And this flexibility is really at the center of what people call the paper-silver manipulation theory. The argument from critics is that by soaking up huge waves of investment money with these paper claims first, funds like SLV can absorb demand that would otherwise force them to immediately go out and buy physical metal, which could, in theory, drive the actual price of silver much, much higher.
All right, let's switch gears. We've talked a lot about the security of the metal, but now let's talk about the security of your profits. Because for U.S. investors, there's a huge tax difference between these two that can have a massive impact on your bottom line.
So, when you sell your shares of SLV for a profit, the IRS doesn't view it like a normal stock. They treat it as if you sold a physical collectible, like a rare coin or a piece of art. And that means your gains get hit with the collectibles tax rate, which can be as high as a painful 28%.
With PSLV, though, it's a completely different story. Now, it's a bit technical. It's structured as a passive foreign investment company, but the bottom line for U.S. investors is that if you file the right paperwork with the IRS, your gains can qualify for the much lower long-term capital gains rate. We're talking 15 or 20%. That is a significant amount of money that stays in your pocket.
So let's just lay it all out, side by side. When you see it like this, the picture becomes crystal clear. PSLV is all about direct physical ownership, fully allocated bars, the Royal Canadian Mint as custodian, redemption rights for investors, and a potential tax advantage. SLV, on the other hand, is really built for price tracking, using a major bank as a custodian, limiting redemption to just the big guys, and it comes with a heavier tax burden on your profits.
At the end of the day, it's not about one of these being good and the other being bad. That's not it at all. They are just very different tools designed for very different jobs. The right choice for you depends completely on what you're trying to accomplish as an investor.
So, you just have to ask yourself, which of these sounds more like you? Are you a short-term trader who needs massive liquidity to jump in and out of the market to play the price swings? If so, SLV is built for that. But if you're a long-term investor, someone who sees silver as a way to preserve wealth and hedge against systemic risk, then PSLV's entire structure is designed from the ground up to eliminate that bank counterparty risk and give you peace of mind.
So it really all boils down to this one simple question. Are you investing just to get exposure to the daily price of silver, or are you investing to actually take possession of the physical metal itself? Answering that one question will tell you everything you need to know.